This new bull market is bull marketing today. The S&P is up 0.71%, following more really good headlines out of China this time. We're going to get into all of your news you need to know, including the CPI report that came out this morning and much more. But let me just reiterate, like I did in the last video, if you are bearish right now, you are clearly holding on to some speculation that things are going to get worse from here. At this point, that is the low likelihood odds. It is a low likelihood that the economy weakens towards something like a recession. It is low odds that this trade deal between the US and China falls apart. So you're fighting an uphill battle, and your portfolio is not going to thank you for it. Just to, again, put that out there before we get started with all of this information. Before we do, again, hit the like button and subscribe to the channel if you want unbiased, just facts and my straight up opinions. Well, this is the place for it. I will also be sharing what Tom Lee said on CNBC last night for all of you, because again, whether you like him or not, I think you should pay attention, especially if you're bearish, if you're hating this market rally, you should really pay attention. Now let's get started with all of your breaking news headlines today before we move into the CPI report. Now, China's finance minister has just said that they will pause the 24% tariff rate on US goods for 90 days. China's finance ministry says the substantial reduction in tariffs between China and the US meets the expectations of producers and consumers in both countries, and it is conducive of economic and trade exchanges between the two countries. And China's finance ministry to cancel additional tariffs imposed on the US products under two later rounds of measures. China's finance ministry also says they will reduce the 34% tariff rates on US goods down to 10% to basically match the US. This will be effective starting tonight at midnight. Now, I imagine, we could see maybe the fentanyl tariffs get paused as well, just so the US and China are both at 10%. Give China some time to kind of crack down on fentanyl before those tariffs go back into effect or stay off. That's speculation. Don't know if that's going to happen. I don't think we need that to happen for this bull market to continue, but it would be a further more positive for US-China relations and for corporate America and consumers in general. Now, Donald Trump also announced a $600 billion Saudi investment commitment in his trip today to Saudi Arabia. Now, US Supercore CPI year over year came in at 2.74%. The previous month was 2.86%. Month over month came in at 0.21%. The previous month was negative 0.24%. So that's still a pretty good number. I mean, if you just times that by 12 times 0.21, you're at 2.5%. That's not a terrible number. Again, if you look at the last 2 months, you're still a little negative if you're averaging that out. So inflation, it's not really a problem at this point. Traders continue to bet on the first Fed cut in September and the second Fed cut in October. Now, if we continue to make progress on inflation, which I think we will, you're going to see more cuts than that, okay? Especially if this trade deal with China gets wrapped up relatively soon and there's more certainty on what tariffs are going to look like, there shouldn't be much holding the Fed back from cutting rates. That's the idea, at least. And this CPI report on a year-over-year basis, this increase today, is the smallest since February of 2021. So let's look at the headline numbers today. So core month-over-month headline came in at 0.2%. Expectations were 0.3%. So that beat on the month-over-month core. Year-over-year, again, came in at 2.8%. Expectation was 2.8%. So not a change there. Headline month over month came in at 0.2%. Expectation was 0.3%. So that was a beat. And headline year over year came in at 2.3%. The expectation was 2.4%. So you're getting close to that 2% target, again, continuing to make a lot of progress, this should likely allow the Fed to cut rates. Now, the NFIB Business Optimism Index came in today at 95.8. The expectation was 94.5. So you actually came in about 1.5 points better than expected. Now, tomorrow, you don't really have much for economic data. Really nothing at all. You have Fed Jefferson that will be speaking, but this market, let's face it, is really dominated by trade headlines and news that comes out on any given day. Okay. Now, we are going to have some earnings today and after hours with Cisco, Iris Energy, CoreWeave, the Metals Company, Nextracker, Luminar, Starbulk, Jack in the Box, and FrontView. But let's just be honest. There's only one earnings that really matters, okay? It's Walmart. Walmart is the only earnings that actually matters, okay, this week. Because they're going to tell us what's going on with the consumer, what they see as far as supply chains and incoming inflation. But again, most importantly, the consumer. Are they still out spending money? Back in, the early days of the global financial crisis or great financial crisis in 07, 08, Walmart was one of the first companies to warn about the consumer, that the consumer was slowing down, that, it was getting rough out there, and they didn't see things getting better anytime soon. Stocks sold off on that. People kind of forgot about it. And then next thing you know, 6 months, 9 months later, we're in a recession, and we all kind of pointed to Walmart as being that leading indicator. Walmart has had really good earnings. They've continued to say good things about the consumer. Do they continue to say the consumer's doing okay? Okay, that would be great. Now, there's really been a push away from consumer discretionary, TVs, tablets, phones, iPads, you name it, fishing gear, like just things that are not necessities, right? We all know what those are. We all love those products, okay? People have not really been buying those products. If people start to pull away from even staples, that would be the bigger issue. Okay, and that's what we will want to watch. And I actually think markets will respond and react to whatever Walmart says tomorrow morning. I think it is a catalyst for the broader markets, believe that or not. And then tomorrow and after hours, Applied Materials, Kava, Take-Two, Galactic, and some others report. And then Friday morning, just some random companies here. Most of you have probably never heard about. Now, also in the news today, Trump envoy Steve Witkoff and Keith Kellogg to travel to Istanbul for Russia-Ukraine talks, according to sources familiar with the matter that told Reuters. So Trump today was invited to join these talks by essentially Zelensky, okay? And these are talks to potentially end the conflict in Ukraine. I mean, I think it kind of looks bad on Russia's part at this point. One, there's not really a lot of progress being made on a day-by-day, week-by-week, or month-by-month basis. That's number one. But, India and Pakistan, they fought for, 2 days, and the situation got settled. Something is clearly wrong with Russia and Ukraine, that this situation is still ongoing. And I think, again, at the end of the day, Putin probably wants, to open up markets, to, become a stronger country. And it looks like the only way to actually do that is to end the war. Israel's Prime Minister Netanyahu said, in the coming days, we'll go into Gaza with full might. So, yeah, that conflict doesn't look like it's slowing down anytime soon. And in a new poll out today, recession risks will have a bigger impact on the U.S. 10-year Treasury yield than higher inflation, said 19 of 33 bond strategists. But again, with this China trade deal, the odds of a recession have plummeted. In my view, they're less than 30%. Okay, probably 20% odds of a recession this year. I also think with this China trade deal, the odds that inflation is a major issue this year have also plummeted. The odds that the Fed is going to cut rates multiple times this year has dramatically increased. And we can start to actually focus on AI and innovation again and the positive things going on in corporate America. Well, also, maybe global markets do open to U.S. businesses. I was explaining this to, yes, a Trump supporter in person yesterday, so keep that in mind. But I was basically telling them how, like, U.S. businesses in China have virtually no, like, penetration. Unless you're Apple, Tesla, Nike, Starbucks, there's not a lot of U.S. businesses in China. It is, believe it or not, a pretty damn closed off market, right? So what if, let's just say what if, big what if, okay? Like, imagine how strong corporate American earnings are right now already without the second largest economy in the world. What if China's market did actually open up in the coming years? I mean, it's hard to even put like a target on where the S&P could go, where certain stocks could go in that event, let alone other areas in the world, right? That's some of the upside that I think Wall Street is really not paying attention to right now. What these trade deals, the positive that could come over the, subsequent years. It's not going to happen all overnight, but over the subsequent coming years, could be very impactful for both China and the US in a positive way. Okay, but we also have the tax bill coming. We also have deregulation. Like, what if no tax on overtime actually happens? What if no tax on tips actually happens? I mean, that's going to give people a lot more money to spend in the economy, assuming that doesn't cause inflation. You're just going to see more activity, okay, which will lead to stronger growth. So I do think there's a very optimistic bull case scenario here that is not being accurately assessed or reflected in markets today. And that is what I am positioning for over the next 6 months, the next 6 years, really. But I do think you will see probably a 20% rally over the next 6 months, which will likely send the S&P close to about that 7,000 level. From current levels, it would be about a 19.3% rally to get to 700 on the SPY. And again, nobody's expecting that. So I think you kind of got to expect the unexpected.
There's the news. Now let's hit your money because let's be blunt. When the tariffs were first announced on April 2nd, markets got crushed. Headlines were all over the place, and not just in the business media. General news leading with stories about stocks falling. I even heard a show talk about retirees, quote, being wiped out. But FundStrat's Tom Lee did not take the bait. He advised clients to hold fast. Said that markets would have to make new highs or would make new highs this year. And guess what? We are there in one of the fastest stock recoveries in history. We are not quite positive on the year yet. Maybe this is the high. Maybe it won't happen. But this has still been an amazing bounce back. Joining us now is FundStrat Global Advisors Head of Research, Tom Lee, also a CNBC contributor. I think you're in like a studio, so you can't run like an actual victory lap, and maybe you're not there to do it yet. But Tom, what did you see that apparently so many others miss? Because I thought we were going to zero.
Well, and zero is always a possibility, Brian, but I think it comes down to three things. The first is the high yield market never confirmed the panic that we were seeing from the economists about the economy. High yield spreads did widen to like 439 basis points wide. But if we were barreling into a recession, they'd get to 700 or so, and they're back down to like 360. The second is that the stock market did have a liquidation event, as you point out, but waterfall declines, all of them, 17 out of 18 since 1950, had a V-shaped recovery. So we knew that whenever the bottom was established, the bottom would be a V-shape. 2022 was the only real exception because of Jackson Hole. And the third is we had a lot of faith in businesses. These companies have been battle tested. They survived a pandemic shutdown. They survived a bullwhip effect from a recovery. They survived the fastest rate hikes in history. So I think that businesses really should get credit, and they've delivered earnings even for Q1 and for guidance that have been way better given the Armageddon that we expected. So I think those three things are the reasons we sort of told our clients to kind of buckle down and even add exposure.
You know, I did something I almost never do, Kelly, which is I deleted a tweet because I tweeted out around that time. I was like, "You're not really losing money
thinking about that tweet.
until you sell." And
You
I meant it.
left it up.
No, I should have, but I meant it, Tom, as a reference to this show that I was listening to on another network where they said retirees are being wiped out, and I was frustrated. I tweeted out, people got a hold of it, and it took this life itself. But my point was that unless you're retiring in a few months or a year, or whatever, or you're 80 years old, whatever it might be, you don't. It's better to be in the market for a long time than to try to time the market. Correct? Like if you're a trader, hedge fund, that's one thing. But if you're a longer term investor with a timeline of more than 5 years, the bias is clearly to the upside. But I think because the sell-off was so politically oriented that it kind of took on a life of its own. Would you agree with that?
Yeah, I mean, there's a couple of factors at work. We were highlighting it during the tariff dislocation, but we know that the equity professional universe of investors, looking at political surveys, more than 60% are Democratic leaning. So their interpretation of the actions of the White House was half empty. So we saw an exaggerated move in equities relative to the bond market, where in the bond market it actually is flipped. In the fixed income world, 60% of bond managers are registered Republicans. And so that's why I think you get better signal, at least in this instance, from what the bond market was doing. And the second is, of course, something people have talked about is the 10 best days. We were highlighting this multiple times that if you exclude the 10 best days of 2023 or the 10 best days of 2024, the S&P only returned 3% a year each of those years. So you need to stay in the market, as you point out, in order to get the 20% gains. And I think this year is another example of people rage sold at 48.35, and now they're buying in today. They missed 1,000 points or 20 percentage points of a gain in 2025.
Do you have any thoughts on kind of bond yields at these levels? Does it matter? I mean, just kind of picking up on what we were just discussing. And for those who missed and wish that they had piled in at the lows now a month ago, what do you say now? That no one now wants to go, all right, fine, I'm going to make my move now, and now stocks are back at the highs. Maybe we then slide lower again. So just some kind of general advice.
Yeah, I've got a couple pieces of advice. I mean, right now, the 10-year yield at 4%, I think isn't a huge burden for not only for the government, but also for the economy or for companies. So I think it's a level of funding that businesses can earn a return on capital. And then as we think about 2026, there's a lot to be excited about. We have deregulation coming. We have the tariff debacle behind us. We have tax cuts possibly. And then we might have better trade partnerships with other countries, meaning U.S. companies have earnings upside. I think that the market is flat year to date through May. So I don't think anyone should feel like they missed anything. I think that they're going to have a chance to buy a lot of companies. A lot of stocks got obliterated. And I think that these washed out names are still opportunities. And we talk about it with our clients, whether it's Tesla or the Mag 7 or the small caps, there's many opportunities still.
So let me know what you guys think about all of this down below in the comment section. Do you think this is the start of a new bull market? Do you think this is a bear market rally, as some are suggesting? Let me know your thoughts down below. Have a fantastic rest of your day, and I will see you in the next one.